Here is what most people do the moment their paycheck hits their account. They check the balance, feel a brief wave of relief, maybe transfer a little something to savings if they remember, and then slowly watch that money disappear over the next 2 weeks. Sound familiar? Well, by the end of this video, you are going to have a complete step-by-step system that runs automatically, protects your future, and actually grows your wealth every single time you get paid. No willpower required. Let me start with something that might genuinely shock you. If you are leaving your money sitting in a regular checking account, you are not just doing nothing with it. You are actively losing purchasing power. With inflation running around 3 to 3.5% right now, and your bank handing you back maybe 0.01% interest, you are losing real value every single month. The bank takes your deposits, lends them out to other people, earns 8 to 10% on your money, and tosses you back scraps. That is not a system. That is a trap. And today, we are getting you out of it. Now, before we jump into the actual steps, I want to tell you something important. Building wealth is not about being some kind of financial genius. It is not about spreadsheets, perfect discipline, or knowing exactly when to buy and sell stocks. The people who actually build serious wealth over time are not necessarily smarter than you. They just have better systems. Systems that run in the background while they sleep, while they travel, while they live their lives. That is the entire goal of what we are building today. So here is the framework. Think of your money flow as a series of bases, just like in baseball. Every paycheck arrives at home base, which is your checking account. And the job of home base is simple. Money comes in, and then it flows out automatically to the right places. That is it. You do not sit on cash in your checking account. You keep just enough to cover rent, utilities, and your regular monthly bills, a comfortable buffer but nothing more. Everything else moves. The very first move your money should make is covering your minimum debt payments. Credit cards, student loans, auto loans, any buy now, pay later balances you have hanging around. This is non-negotiable. Missing even one payment wrecks your credit score, and a damaged credit score makes everything harder and more expensive, from renting apartments to getting a decent mortgage rate down the line. So before anything else, make sure those minimums are handled. And the easiest way to guarantee this happens is by automating it so you never even have to think about it. Speaking of automation, let me just say this clearly. Automation is the single most powerful financial decision you can make right now. The psychology behind it is incredibly simple. You cannot spend money you never actually see. When transfers happen automatically before you even have a chance to feel tempted, you are not relying on motivation or discipline, both of which are notoriously unreliable. You are just building wealth on autopilot. Take 15 minutes after this video ends and set up recurring transfers for everything we cover. Your future self will thank you. Next stop is your monthly operating budget. This means knowing exactly how much it costs you to exist every single month. Rent, groceries, transportation, utilities, insurance, phone bill, all of it. Add that number up and make sure it is always covered in your checking account. A solid framework here is the 50-30-20 rule. 50% of your take-home pay goes toward needs, 30% toward wants, and 20% toward saving and investing. If you live somewhere with a high cost of living, your needs percentage might creep closer to 60. That is fine. Just know your actual numbers. Once your essentials are covered, the next priority is building your emergency fund. This is your financial shock absorber. In 2026, with economic uncertainty at an elevated level, most financial experts are now recommending 4 to 6 months of living expenses rather than the old 3-month standard. So if your monthly costs are around $2,500, you are aiming to have somewhere between $10,000 and $15,000 sitting in a dedicated account that you do not touch unless something genuinely goes wrong. Job loss, medical emergency, car breaking down, that kind of thing. Not in your regular savings account paying next to nothing, but in a high-yield savings account. These online accounts are currently paying somewhere around 3 to 3.5% annually, which is significantly better than the fraction of a percent you would get at a traditional big bank. The money stays completely accessible whenever you need it, but it is quietly earning interest in the background. Links to some of the better options available right now will be down in the description. Here is the key thing about the emergency fund. Once you hit your target number, you stop funneling extra money there. You have done that job. Now, your money has a new mission. And that mission is investing for retirement, which is step 4. And genuinely one of the most impactful things you can do for your financial future. In 2026, the contribution limit for a 401k is $24,500 per year if you are under 50. If your employer offers a contribution match, you absolutely must contribute at least enough to capture the full match. That is literally free money being added to your retirement account. Do not leave it on the table under any circumstances. Now let me give you some compound interest math that should motivate you deeply. If you invest just 10% of a $75,000 salary consistently for 40 years with an average 8% annual return, you're looking at over $2 million by retirement. The single biggest variable in that equation is time. The earlier you start, the more time compounding has to work its magic. Starting at 25 versus starting at 35 is potentially the difference of hundreds of thousands of dollars. After capturing your employer match, the next best investing move is opening a Roth IRA if you do not have one already. The Roth IRA is incredibly powerful because your money grows completely tax-free. You contribute after tax dollars, meaning money you have already paid taxes on, and then every dollar of growth in that account is yours when you retire with zero tax owed. The contribution limit in 2026 is $7,500 annually if you are under 50. One critical mistake people make is putting money into a Roth IRA and then forgetting to actually invest it. The money does not automatically buy anything. You have to log in and choose what to invest in. Index funds and ETFs that track the broader market are excellent starting points for most people. Once your retirement accounts are handled, step 5 is dealing with any remaining high-interest debt. Anything above 15% interest should be aggressively targeted. Two popular strategies here are the avalanche method, where you attack the highest interest debt first to minimize total interest paid, and the snowball method, where you knock out the smallest balances first for psychological momentum. Both work. The best one is whichever one you will actually stick with. For lower interest debt under 5 or 6%, it can actually make more financial sense to keep investing while making regular payments, since the stock market historically returns 8 to 10% annually. But if carrying that debt stresses you out, paying it down first is also a completely valid choice. Personal finance is personal. Step 6 is investing beyond your retirement accounts in a regular taxable brokerage account. No contribution limits, no lockup periods, full access to your money at any time. The trade-off is that gains are taxable when you sell. Holding investments for longer than a year qualifies you for lower long-term capital gains rates, so patience pays off here literally. Finally, step 7 is building multiple income streams. Research consistently shows that most self-made millionaires have at least 3 sources of income: freelancing, dividend stocks, content creation, online businesses, teaching skills you already have. Even a few extra hours per week building something on the side can translate into hundreds of extra dollars monthly, and all of that feeds right back into the earlier steps of this system. Here is the bottom line. This system works not because it is complicated, but because it is consistent. Automate the flow, stack each step in order, and let the machine run. Most people spend their whole lives stressed about money. This approach flips that completely. Start today, even if it is just $10. A year from now, you will be genuinely glad you did.